Despite falling over 70% from its all-time high, Duolingo stock is still the next 100 bagger, and I'm about to show you why. We'll look at how Duolingo makes money, the company's moat, fundamentals, and investment risks. I'll also reveal my Duolingo stock valuation towards the end. I don't own Duolingo stock yet, however, I'm looking closely at the opportunity right now. I could potentially add it to my $10,000 eToro portfolio. So what actually is Duolingo? Duolingo is a gamified learning app that teaches languages and now math and music through short, interactive lessons designed to feel more like a game than a classroom. But how does a free-to-download app like Duolingo make money? Duolingo makes money primarily through its freemium model. Most users learn for free, but revenue comes from paid subscriptions, ads, English proficiency testing, and in-app purchases. Subscriptions are by far the largest income stream, accounting for $806 million out of the company's $964 million in annual revenue over the last 12 months. Duolingo currently has 11.5 million paid subscribers, and that number has grown at a rate of 50% per year over the past 5 years. Although subscriber growth has slowed, the number of paid users is expected to grow at around 15 to 20% per year going forward. Their continued subscriber growth is supported by their 135 million monthly active users. The percentage of monthly users that are paid subscribers reached an all-time high of 9% in the last 12 months. This is much lower than other freemium-based services like Spotify, which has sustained around 40% paid subscription penetration. This suggests that Duolingo has even more room to expand their paid subscription penetration from here. So that's the business model, but what's Duolingo's moat? Duolingo's moat comes from its scale, proprietary user data, AI-driven personalization, and brand identity. These advantages make it difficult for competitors to replicate its engagement, cost efficiency, and rapid content expansion. Duolingo's strongest competitive advantage is its network effect. A network effect is when a product or service becomes more valuable as more people use it. The reason why Duolingo's network effect is so crucial is because every new user adds to their dataset of how people study, which strengthens the app's ability to personalize lessons. If millions of users struggle with a particular language problem, Duolingo's algorithms detect patterns and adjust exercises accordingly. This makes the app more effective for all learners, not just the new ones. And when learning a language, there's always something new to discover. Think about your own first language. There's basically unlimited ways to expand your understanding. More users also means more competition on leaderboards and leagues. That social pressure motivates daily engagement, which in turn keeps retention high. No other edtech platform has reached anywhere near the scale of Duolingo's 134 million monthly users. Duolingo's sustainable freemium model has attracted a massive global audience, which they can then convert into paid subscribers over time. The company's competitors mostly rely on upfront payment, limiting their reach. Duolingo is also using artificial intelligence to extend its lead in edtech. AI powers their premium subscription tier, Duolingo Max, which includes a role-playing feature with an AI partner in real-world scenarios like ordering coffee, booking travel, or chatting with a friend. The AI responds naturally, giving users a safe space to rehearse speaking skills without fear of judgment. The company is also using AI to accelerate content creation, with 148 new courses launched last quarter alone. AI integration has also helped to reduce content costs, lifting gross margins to 72%. Now that we understand Duolingo's moat, let's take a look at the company's fundamentals. This part might be surprising. Duolingo's balance sheet is perfect, with over $1 billion in cash and zero debt. Duolingo's shares outstanding have steadily increased over the years as the company uses stock-based compensation to entice new employees to join the business. Although this trend is a negative mark against the company due to their huge cash pile and increasing free cash flow generation, I wouldn't be surprised to see it reverse direction with the introduction of a share buyback program. Share buybacks could be a smart move, especially with the company's valuation falling off a cliff recently. In the same way we look for undervalued stocks as individual investors, it makes sense for a company to buy back its own shares if the stock is undervalued and the company has excess cash on hand. The real story here is margin expansion. Due to increased monetization, Duolingo's profits have exploded. If we take a look at the company's operating margins, we can see negative margins back in 2023, which have climbed to an impressive 13% in the last 12 months. Every new paid subscriber should boost margins even higher over time. Now let's address the elephant in the room. We have to discuss Duolingo stock's investment risks. The main risk, which is also the reason why Duolingo stock is down so much from its all-time high, is management's shift in focus from monetization to user growth. Duolingo's management is explicitly prioritizing daily active user growth and teaching quality over monetization in product experiments and resource allocation. This includes choosing not to launch changes that would clearly increase bookings if they hurt daily active users, and shifting some effort away from monetization toward teaching quality. As a result, Q4 2025 bookings growth is expected to decelerate, and similar trade-offs are expected to persist into 2026. While management believes this will maximize customer lifetime value long term, it introduces the risk of slower revenue growth over the next several quarters. This is obviously something to pay close attention to in future earnings calls. However, I like the fact that management is prioritizing long-term value and user experience over short-term monetization. EdTech has a huge total addressable market which will continue to grow for decades. Therefore, it would be smart of Duolingo to solidify their spot as the market leader rather than chasing profits just to please Wall Street. Right, now for the part you've been waiting for. Let's look at Duolingo stock's current valuation and calculate what kind of return the stock could provide if bought at today's price. On the surface level, a PE ratio of 28 times 2027's projected earnings seems pretty reasonable for a fast-growing company like Duolingo. Spotify stock, which shares many of the same characteristics as Duolingo, also currently trades at a 28 times 2027's projected earnings. As you can see from the chart, Duolingo's free cash flow yield is the highest it's ever traded at. Free cash flow yield is the valuation metric that I focus on when analyzing highly cash generative businesses like Duolingo. The higher the free cash flow yield, the cheaper the stock, and vice versa. It's very rare to see a company expected to grow revenue in the 15 to 20% range with expanding profit margins and zero debt trading at a 5% free cash flow yield. On that metric alone, the stock looks cheap. However, let's actually take a look at Duolingo's valuation using the DCF calculator on Qualtrim to see if the stock is truly undervalued. So first, let's come up with an estimate for Duolingo's free cash flow per share growth rate over the next 5 years. Even after adjusting for the company's stock-based compensation, Duolingo's free cash flow per share has grown at a staggering rate. I think it's reasonable to assume Duolingo's free cash flow per share grows at a rate of 15% annualized over the next 5 years. This may even be conservative depending on how much user and revenue growth Duolingo sees with potential monetization benefits from higher paid subscription penetration and maybe even price increases somewhere along the way. But now for the tricky part. What is the appropriate free cash flow yield for Duolingo stock to trade at? I think the current 5% is too high. However, I wouldn't say that Duolingo stock should trade around a 3% free cash flow yield like Spotify or Netflix because they have significantly stronger business models. However, I'm comfortable with Duolingo trading at a 4% free cash flow yield. With these assumptions, which I believe are pretty conservative, Duolingo stock could provide a market-beating return of over 20% annualized over the next 5 years from today's price of $150 per share, meaning the stock could trade at $385 per share in 2031. If you enjoyed this video, click the next one for more.